Okay, so I got a call a few months ago from a physician I know, and she had been investing in real estate, some active, but many things passively for a couple of years in syndications and funds. She had done a few deals and felt like she was getting the hang of it for the most part. And then she got an email from one of her sponsors. And the subject line was something like, important update on your investment. And she opened it wondering whether it'd be about a distribution or maybe distributions would get restarted. Instead, it was a capital call. The sponsor needed more money from investors to keep the deal moving forward. And she called me, and when we talked, she said, is this normal? What should I do? Should I send money? What happens if I don't? Now, I've had that conversation with physicians more than once, especially in the last couple of years in real estate. I've had to have some of those calls on my own sometimes. And if you've been investing passively for any amount of time, especially over the last 3 to 5 years, you've probably gotten that email too in some way, or you might. So today we're going to cover what a capital call actually is, why this specific market cycle has produced so many of them, and what your real options are, and how to evaluate what you're being asked to do before you make a decision. If that interests you, stay tuned.
Welcome to the Passive Income MD podcast, where we talk about creating your ideal life through multiple streams of income. If you enjoy hearing about this stuff, make sure to hit subscribe. Now let's get on with the show.
All right, welcome back to the podcast. Hope you've had another great week. This is going to be an interesting topic. Now, a quick note before we get into it. Everything I share today comes from my own experience, both as a passive investor who has received capital calls and a sponsor who has sent them. Now, it's not financial advice. Every deal and situation is different. So again, take what's useful, leave what isn't, and let's get into it. First of all, some of you might be wondering, what is a capital call? Now, a capital call is when a sponsor comes back to their limited partners and requests additional capital beyond the original investment. And I want to say something up front that most people don't always talk about. A capital call is almost always the last thing a sponsor wants to send. Think about it from their side. They raise money from investors who trusted them with this capital, going back to those same people and saying, we need more money. That's not something any operator does lightly. But by the time that email goes out, they've typically already looked at every other option. They stress tested the numbers, and they've had hard conversations internally or with lenders. And this is where they landed as the best next step forward. And of course, that doesn't mean the capital call represents good news, but it does mean the sponsor is fighting for the deal and not walking away from it. And that context matters when you're deciding how to respond. Now, a lot of people have been receiving more of these lately, and there's a specific reason for this, actually. The Federal Reserve raised rates 525 basis points between March 2022 and July 2023. That's the fastest tightening cycle in pretty much 40 years. So many real estate deals underwritten in 2020 all the way up to 2022 were built around a very different rate environment. There were low rates, abundant debt options, strong rent growth, and that environment has been totally wiped out. It's totally gone. And the deals structured around it are feeling the pressure for sure. And here's what's specifically driving the capital calls you're probably seeing today. Again, floating rate bridge loans. A lot of value add multifamily deals were financed with short-term floating rate debt. And the plan was to renovate, stabilize, and sell or refinance into long-term fixed debt within a couple years. Now, when rates rose and values as a result of these properties softened, that refinance either became impossible or required significant additional equity to close that gap for the lenders. Another thing that happened is something called rate cap expirations. Now, when sponsors took out floating rate debt, lenders required them to buy something called rate caps to limit their exposure. Now, rate caps are almost like insurance products if in the case that rates do rise, and they are forced to buy them. Now, those caps have started expiring 2 to 3 years later, and renewing them at today's rates costs so much more than the original caps did. I've seen ones that were maybe $30,000 when they went to the deal, and then was $1.3 million when they actually needed to buy a new rate cap. Now, that's a real cash need that wasn't in the original budget. Also, there's been rising operational costs. Insurance premiums have increased a ton in so many markets, especially in the South and Southeast. Labor and materials due to inflation for renovations came in higher than projected. Again, these aren't excuses for anyone. They're just real line items that, again, moved against deals that had little margin to absorb them, or maybe they had margin, but they didn't expect all of these things to happen at the same time. As we all know, rents also stopped growing. And in many markets, the strong rent growth that operators underwrote or expected some rent growth either slowed or even reversed as new supply, so new buildings came online. And that affected cash flow and made refinancing at any sort of good terms really harder to actually make happen or to execute. Now, here's the important thing I want you to hold on to. Again, none of this is unique to one sponsor or one market. This is a cycle-wide pressure that has stressed deals across the entire industry. And so many sponsors that are sending capital calls, they're experienced people. They're operators who have done well in previous downturns and they're ones that made reasonable assumptions over the last couple of years that the rate environment just made unsustainable. And knowing that context, especially for you as the investor, doesn't mean that you should write a check automatically. It means that you evaluate the situation with the right frame. So with that in mind, I'm going to go a little bit deeper into what actually triggers a capital call. I'm going to try to be as comprehensive as possible. Now, one of the most common causes is bridge loan maturity. That means that the short-term debt is coming due, meaning that they had a short-term debt for 3 or 4 years and it's coming near the end. So the sponsor needs capital to either extend, refinance, or pay it down. Like floating rates that worked when they acquired the building stopped working when rates moved, when they moved higher. As I mentioned, rate caps have expired, so maybe they need additional capital to renew them, and they cost way more than the original budget allowed. There might be unexpected capital expenditures. We're talking about something that the inspection missed, a roof, a repair that the reserves can't cover. Costs have gone higher. Maybe occupancy isn't where they expect it to be. Maybe they're not leasing these properties at the price or at the cost that the business plan assumed. Now, just so you know, the size of the capital call ask matters. I've received capital calls ranging from 7% of my original investment all the way up to 40%. And these are not really the same conversation. I think a 7% ask is, if they're trying to renew a rate cap, that could be a relatively contained situation. But a 40% ask to restructure debt on a struggling asset, it's fundamentally a different situation and one that requires a different level of scrutiny or diligence. And I think the size of the ask is probably your first signal. It tells you something about the scope of the problem before you've read a single word of the memo. And here's the important framing for this moment. When you receive a capital call, you're not just deciding whether to send money, you're essentially making a new investment decision with updated information. When you evaluated this deal the first time, you looked at the sponsor's track record, the business plan, the market, the projected returns, all of the risk. And honestly, you have to do that same work again. The situation has changed now. Now, a few years later, the reality is different and the analysis has to change with it.
Hey, if you've been listening to this podcast and you're feeling motivated, but maybe a little isolated, like the people around you just don't quite get what you're trying to build, I think you'd love PIMD Con. It's our annual conference, and honestly, the thing I hear most from people who come for the very first time is that it feels like a homecoming. 3 days, surrounded by hundreds of physicians, all moving in the same direction, learning about real estate, entrepreneurship, and what it actually looks like to build the life you want. PIMD Con 2026 is September 24th through 26th in Dallas. Early pricing won't last long, so if you're even a little curious, check it out now at pimdcon.com/tickets. We'd love to see you there.
So here's what you need to get clear on before you make any decisions. First, what is the money specifically going to be used for? Not a general explanation. You should know specific use of the funds. Is it to extend a loan, cover renovation, to stabilize occupancy, to shore up reserves? The more specific the answer, the better the sign is for you as an investor. If you get vague answers to this question, that is definitely a red flag. A sponsor who knows what they're doing can tell you pretty much exactly where every dollar is going that they're going to raise. Second, what does a revised business plan look like? Not just what went wrong. Where is this deal going from here? Like, what's the updated timeline? What are the new projections given where the market is today and moving forward? And does the math still make sense? Or is this capital call just buying time on a deal with no real path to recovery? Those are two very different situations, and you need to know which one you're in. Third, what happens if the capital call is not met? They didn't raise enough capital for it. And this is the question most investors forget to ask. So ask it directly. Get a clear answer. Is there a risk of default, of losing the property? Could the lender foreclose? Is a sale being considered? Is there another plan? Like, you need to understand the downside of saying no, not just the upside of saying yes. And lastly, what does a capital call memo actually show you? Read it carefully. Look for a clear breakdown of how the funds will be used. Again, look for updated financial projections that reflect current conditions, not just the original underwriting. Look for a realistic exit timeline and look for what the sponsor's already done to stabilize the deal before sending this request. If a sponsor can't answer any of these questions or these questions clearly, that can tell you as much information as the capital call itself. So now let's talk about your two options. When you hear all of this stuff, when you find out all of this information, you've done your due diligence, you've got two options. You contribute or you pass. And let me take a look at each one of these honestly. Now, if you decide to contribute, you've evaluated the revised plan and it holds up under scrutiny, again, today's market. And the ask makes sense. It's proportionate to what's needed. And you decide at this point, all right, I'm going to put in more capital. I mean, I've done this before. There have been deals where contributing was clearly the right call because the asset was fundamentally sound. The issue was mainly market driven and not operational. The sponsor had a credible plan for what was going to happen with the capital. And putting all this together, it helps you put the math to the reality and makes you optimistic for where things will go. Now, the second option is you pass. Maybe the revised plan doesn't hold up to you. The numbers don't work, even with new capital. The sponsor can't clearly articulate the path forward, or the ask is honestly too large relative to what you can realistically recover. And I passed on capital calls too. And that feels uncomfortable because when you decline, and let's say other limited partners contribute or other investors contribute, your equity usually gets diluted. So here's what that actually looks like. Let's say you invested $100,000 in a deal where your total LP equity, total investments is $2 million. That's a 5% ownership stake. Now there's a capital call. I'm just making the numbers easy in this scenario. Let's say it's $400,000 and you decline and other LPs contribute. So the total equity is now $2.4 million because the original $2 million and $400,000 from the capital call. And so your $100,000 stake is now roughly 4.2%. You still own a piece of the deal, but it's a smaller piece. And that's the real cost of passing. So you want to run the math before you make the call. I mean, sometimes that cost is worth it if the deal has no credible future. You don't want to throw good money after bad. Again, sometimes it just doesn't make sense. That judgment is yours to make with the information that's put in front of you. Now, let me say something directly about the difference between operators. Not all capital calls are the same situation. There's a meaningful difference between a sponsor who hit a market condition they couldn't control, maintained transparent communication throughout, and explored every alternative before coming back to investors. And then they came back and returned to you with a specific use of funds, a credible revised plan, and even put in some of their own capital alongside yours. It's very different from that person and a sponsor who mismanaged the asset, maybe gave vague or frequent updates along the way, and is now asking for more money without being able to clearly explain what changes and why the new capital solves the problem. The capital call itself, again, doesn't tell you which situation you're in. It's the quality of the communication, the specificity of the plan, and even the sponsor's track record leading up to this moment, and how they behaved when things got hard. That's going to tell you so much more. A good operator in a bad market is a fundamentally different situation from a bad operator in any market. And how you respond should reflect that difference. So here's the takeaway. A capital call is not a verdict on your investment. It's a decision point. The worst thing you can do is respond emotionally. Maybe contribute because you're afraid of losing what you have. That's not a strategy. Or passing because the ask makes you uncomfortable. That isn't either. Again, the standard is the same one you applied going in. Evaluate the sponsor, the revised plan, and the underlying asset. Ask the hard questions. You can do that. Get specific answers. Run the dilution math if you're considering passing, and then make a decision you can stand behind. Investors who navigate these well aren't the ones who never receive capital calls or run into situations, they're the ones who know what to do when they do receive that situation. Okay? Thanks for listening, everyone. See you next week.
Enjoy the show? Let me know by dropping a review in the podcast app you're listening to us in. And if you haven't already, make sure to hit subscribe. Join thousands of physicians who are also on this journey to creating their ideal lives through multiple streams of income. Learn more at our website, passiveincomemd.com. Thanks again for allowing me to be a part of your journey. See you next time.